Welcome, and thank you for joining us today on this exciting journey towards financial freedom. We're here to explore the path to retiring at the age of 40, starting as early as 18. This may sound ambitious, but with careful planning and dedication, it's entirely achievable. Let's begin by laying down the groundwork for your financial success. First and foremost, let's discuss the remarkable power of compounding. This is where time becomes your greatest ally. When you start investing at a young age, your money has more time to grow exponentially. Think of it like a snowball rolling downhill, gaining both size and momentum. The sooner you start, the more your wealth can snowball. Now, to embark on this journey, you need a destination. You must define your retirement goals. What kind of lifestyle do you envision in your retirement years? Consider factors like inflation and the cost of living to arrive at a realistic financial target. Having a clear goal will give your investments purpose and direction. Next, it's essential to assess your risk tolerance. Everyone's comfort level with risk varies. Are you conservative, preferring lower risk investments, or are you more adventurous, willing to take on higher risks for potentially greater rewards? Your risk tolerance will influence your investment choices. Before we dive into the world of investments, it's crucial to build a sturdy financial foundation. This foundation will protect your investments from unexpected shocks and ensure your long-term success. Start by establishing an emergency fund. This fund should contain at least 3 to 6 months' worth of living expenses. It acts as a safety net, shielding your investments from unexpected financial crises. Additionally, consider tackling high-interest debt. Pay off credit card balances and other high-interest loans as a priority. By doing so, you not only reduce financial stress, but also free up more funds for investing. Budgeting is another fundamental aspect of your financial foundation. Creating a budget allows you to track your income and expenses meticulously. It's a tool that ensures you're living within your means and can allocate funds for investments as planned. Now, let's explore the vehicles available for your investments. There are various options, each with its own set of advantages and risks. Here's a brief overview. Stocks. Investing in individual stocks means you become a partial owner of a company. Research and select companies with strong fundamentals and growth potential. Bonds. Bonds are essentially loans to governments or corporations. They offer regular interest payments and return your principal upon maturity, making them lower-risk investments. Mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks and bonds. They offer diversification and professional management. Exchange-traded funds, ETFs. ETFs are similar to mutual funds but trade on stock exchanges. They provide flexibility and often have lower expense ratios. Real estate. Investing in real estate, such as rental properties or real estate investment trusts, REITs, can provide rental income and potential property appreciation. Now that we've discussed investment vehicles, let's delve into strategies for success in investing to retire at 40. Dollar cost averaging, DCA. DCA involves investing a fixed amount of money at regular intervals regardless of market conditions. This strategy reduces the impact of market volatility and helps you buy more allows when prices are low. Adopt a long-term perspective. Avoid constantly trading in response to market fluctuations. Patience is a key ingredient for successful investing. Diversification is essential. Spread your investments across different asset classes to reduce risk. Diversification can help balance your portfolio and protect you from significant losses in any one area. Tax-efficient investing. To maximize your returns, make use of tax-advantaged accounts like IRAs and 401(k)s. These accounts offer tax deductions and tax-free growth, which can significantly boost your savings over time. We'll explore specific steps and strategies to help you invest for your retirement with the goal of retiring at 40. Let's jump right into it. First and foremost, retirement accounts should be a cornerstone of your investment strategy. Two primary types of retirement accounts are essential to consider. 1. 401(k) or similar employer-sponsored plans. If your employer offers a 401(k) plan, take full advantage of it. Many employers even offer a matching contribution, essentially giving you free money for your retirement. Maximize your contributions to get the most out of this valuable benefit. 2. Individual retirement accounts, IRAs. IRAs, including traditional and Roth IRAs, provide additional tax advantages. Traditional IRAs offer tax-deferred growth, while Roth IRAs provide tax-free withdrawals in retirement. Depending on your income and tax situation, you may choose one or both. Maximizing your contributions to these accounts is crucial. The more you save in tax-advantaged accounts, the faster your retirement nest egg will grow. For 2024, the maximum annual contribution limit for 401(k)s is $20,000, while for IRAs, it's $6,000. Asset allocation is another critical factor in your retirement investment strategy. Your asset allocation should be based on your risk tolerance and time horizon. Generally, when you're younger and aiming to retire at 40, you can afford to take on more risk because you have a longer time to recover from market downturns. As you get closer to your retirement age, you may want to gradually shift towards a more conservative allocation. Keep in mind that staying informed is essential. Regularly educate yourself about investing. Keep up with market trends, financial news, and investment opportunities. Staying informed will help you make well-informed decisions and adapt to changing market conditions. Regular review of your investment portfolio is essential. Set aside time to assess how your investments are performing and whether they align with your goals. This review should take into account factors like your asset allocation, risk tolerance, and the overall performance of your investments. Rebalancing is a crucial step in maintaining a healthy portfolio. Over time, as some investments perform better than others, your asset allocation can become skewed. To rebalance, you may need to sell some assets and buy others to restore your desired allocation. This process ensures that you don't become overly concentrated in a single asset class, which can increase risk. Be prepared to make emergency adjustments when necessary. Life is unpredictable, and unexpected events can impact your financial situation. It's essential to have a plan in place for emergencies, such as health crises or sudden job changes. Having an emergency fund, as discussed in Chapter 2, can help you weather these storms without disrupting your long-term investment strategy. Finally, remember that investing is not a static process. Your financial goals and circumstances may change over time. Be open to adjusting your strategy as needed. Seek professional guidance if necessary, and don't hesitate to consult a financial advisor who can provide personalized advice based on your unique situation. As we approach the conclusion of our journey towards retiring at 40 through wise investments, let's delve into a crucial aspect of this path: staying committed. Achieving financial freedom and retiring at such a young age is a commendable goal, but it demands unwavering dedication and discipline. In this chapter, we'll explore strategies and mindset shifts that will help you maintain your commitment throughout the journey. First and foremost, it's essential to realize that this endeavor is a marathon, not a sprint. Patience is a virtue in the world of investing. Many investors get caught up in the allure of quick gains and frequently buying and selling assets in an attempt to outsmart the market. However, this approach often leads to higher costs and lower returns. Instead, adopt a long-term perspective. Understand that markets will go through ups and downs, and that's perfectly normal. Avoid making impulsive decisions based on short-term market fluctuations. Trust in your well-thought-out investment strategy and stay the course. Remember that compounding works best over time when you remain invested consistently. Managing emotions is another critical aspect of staying committed. The financial markets can be emotionally charged, with periods of exuberance followed by fear and panic. It's crucial to avoid letting emotions drive your investment decisions. Make rational, well-informed choices based on your goals and risk tolerance, not on the latest headlines or market noise. One practical way to reduce emotional decision-making is to automate your investments. Set up automatic contributions to your retirement accounts so you consistently invest a portion of your income without having to think about it. This approach not only ensures that you're saving regularly, but also removes the emotional component from the equation. Consistency is key to successful investing. Whether the market is booming or in a downturn, stick to your investment plan. Some of the most significant gains in the market come when least expected. Trying to time the market often leads to missed opportunities and losses. Diversification is another powerful tool for staying committed. By spreading your investments across different asset classes, you reduce the impact of poor performance in one area. Diversification can help smooth out the ride, making it easier to stay the course during turbulent times. Avoiding the temptation of trying to get rich quick is vital. There are countless stories of investors who became overnight millionaires through speculative bets or risky investments. However, for every success story, there are many more tales of financial ruin. Instead, focus on your long-term goals and the slow and steady approach to building wealth. Lastly, don't be afraid to seek professional guidance. Consulting a financial advisor can provide you with valuable insights and personalized advice. They can help you make informed decisions, navigate complex financial situations, and stay committed to your retirement goal. Retiring at 40 is a realistic goal if you start early, set clear objectives, and follow a disciplined investment strategy. By building a strong financial foundation, selecting the right investment vehicles, and adhering to proven investment strategies, you can set yourself on a path to financial freedom. Remember, it's not about timing the market, it's about time in the market. The sooner you start, the more time your investments have to grow and compound. Stay committed, stay informed, and be prepared to adapt to changing circumstances. With determination and the right approach, you can achieve the financial independence you desire and retire at 40 with confidence. Thank you for joining us on this journey towards financial success.